Hello, everyone, and welcome back to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Wednesday. It's June 1st. I'm Mike Burnick, and joining me today are Mike Larson, Kathy Lean, Boris Schlossberg, and David DUTKEWYCH. All right, let's go ahead and get started. Well, Mike Larson, you said it yesterday in a Money and Markets article. You wrote that we have a data deluge kind of week with lots of economic data out. We got Purchasing Managers Index readings from the Eurozone today, which declined a little bit, and in Asia, China's was pretty much unchanged for the month, which is basically just barely showing a pulse of any kind of manufacturing growth at all. U.S. reading comes out a little later today, and of course it's a very busy week, and this holiday shortened week actually climaxing, if you will, with our jobs report on Friday. So what does the latest data tell you about the state of the economic growth here in the U.S. and around the world, Mike?
Yeah, thanks, Mike, for that intro. You're right. This is a very, very busy data week. When you look at what came out yesterday, personal income and spending for April was a little better than expected. Housing prices were a little better than expected. Some of the regional manufacturing surveys were worse than expected. Dallas was a disaster. Chicago was kind of lame. The overnight data on manufacturing, again, as you mentioned, out of Europe was pretty disappointing. And the funny thing about China's numbers is mysteriously, just like GDP, they always come in line with what the government says they will over there. So,
Imagine that.
I'm sure it's just an amazing coincidence. But, some of the private surveys over in China have looked worse than the quote-unquote official government data. So I think probably we all know, and the markets realize things in China aren't going so well. Japan's number was the worst in many, many months, which shows that the Abenomics program has been an utter disaster over the years and hasn't accomplished anything. So, we've got that backdrop today. We've got national manufacturing data. We've got auto sales figures coming out. Obviously, the jobs data that comes out in the next 2 days is the big doozy for U.S. numbers. I think if you sum them all up, I tend to believe the U.S. economy is sort of in a pre-recessionary environment. We've seen the credit cycle turn. I believe the best of the economic growth cycle is behind us. It's just getting tired. Policy isn't really working anymore. And the credit markets, despite some temporary improvement based off of ECB corporate bond buying, just don't look all that inspiring. So that's what I'm expecting. Who the heck knows on these monthly jobs figures if we get some kind of positive surprise. Obviously, I think the market's going to greet that well. But I think that the possibility of a negative surprise is much larger. So we'll see how that plays out. The numbers are not screaming recession yet, but to me, they are pointing towards slowing growth. And if I'm right about where the cycle's going, we'll be talking about more recessionary figures in the next 6 to 12 months. So I remain cautious when it comes to my investing stance. I think sentiment's very bullish, just given the recent bounce in the market. But the ironic thing is, sentiment's getting all balled up and volatility's at multi-month lows. When basically the stock market's been here how many times in the last 18 months? I mean, look at a chart of the Dow or S&P. It's done absolutely nothing on a net basis since November of 2014. And during that period, there's been 2 big drawdowns. So you're getting more shorter-term drawdowns and painful moments for no net progress. So it kind of makes people think, what's the point of taking on the risk? So I think unless we get some huge dramatic breakout that really causes people to embrace stocks, it's going to be kind of more of this tough slog in my view.
Okay. Thanks, Mike. Appreciate the update. Let's see, Boris Schlossberg. We've seen certainly some big movements, in currency markets recently, especially the dollar, which kind of bottomed around the beginning of May, along with the Fed indicating that they may be raising rates sooner than expected. What's your take on the markets right now?
Well, it's still very much likely that the Fed is going to raise rates either in June or July and then pretty much stay dormant until the end of the year, unless we get much greater turbulence than anybody expects and really, really bad readings. The one thing about this month's NFP reading is that there's a skew because of the Verizon strike. So I think the market at this point anticipates that it could be a lower reading, maybe even 125,000 because of that. But then next month is going to be a big bounce back because they negotiated a deal. The much more important numbers to look for on this Friday's report is going to be the average weekly earnings numbers. And if those continue to point up, the pressure on the Fed to normalize rates is going to, I think, ratchet up considerably. Overnight trade today, we had a lot of volatility in the currency market. Dollar-yen dropped through some very key levels. It broke below the 110 support, kind of testing almost in front of the 109 support as I speak right now. All of this on news that Japanese Prime Minister Abe decided to hold off on any further sales tax increases for 2.5 years. Now, everybody expected that to happen, for him to kind of delay it, but nobody expected the delay to be that long. And that suggests that I think Japan still remains very much in trouble. It goes to Mike's point, I think, that we're not in a recessionary cliff just yet, but we're clearly in a global economic slowdown. And whether we can just stabilize and resume growth remains to be seen. So I think the only reason why the Fed may hold off on rate hike right now is because they just may be terrified of making a policy mistake of raising rates just at the cusp of a slowdown in the U.S. economy. But at the same time, they really need to establish some sort of credibility with the market. And if they don't, you could have actually the inverse reaction. I think just like with the Bank of Japan, when they went negative and they thought that would be positive for the yen, the market actually took that as a very, very negative sign of capitulation. If the Fed backs off and does not raise rates, you could actually see the stock sell off on fears that the market is seeing something, believing that the Fed is seeing something that nobody else is seeing. So I generally do not feel comfortable with equities at this point. I do think the dollar should strengthen moderately, assuming the Fed hikes in June or July. And other than that, the climate just looks to be sort of medium to tepid as far as economic growth.
Okay, thanks, Boris. Appreciate that update. Kathy Lean, do you have anything to add from your perspective?
Yeah, basically, when we started the month in May, we talked about how May tends to be a very good month for the U.S. dollar. And, now we've kind of extended that streak with the dollar having risen for the past 7 years in the month of May. So now that, we're in the first day of the new month, everyone's kind of wondering, can this trend continue? Boris is right. We've got the FOMC meeting, which, should be more positive for the dollar. But I think what's important to remember is that after such a strong month, we do tend to see on a seasonal basis a little bit of a pullback in the greenback. The dollar index itself actually in the month of June declined 8 out of the last 10 years. And if we look at a shorter period over the last 6 years, it actually fell every single month. Now, the losses were not significant. Most of the time, it was less than 1%. But I think that it's something to keep in the back of the mind. This year, we obviously have a significant vet risk in June that everyone's looking forward to. That could end up overshadowing the seasonal factors. But I do think it's important to be aware of the kind of profit taking that can happen in the month of June after such a strong move in the month of May. And that could be driven by just excessive expectations. We're already seeing the dollar weak this morning. So we're starting off from a softer base. And I think, with the dollar against the yen pair, which, many, both Boris and Mike have kind of mentioned a little bit, there's not as much seasonal factor. 5 out of the last 5 years, it was down, so that means the other 5, it was up. But we see very, very strong seasonality in the British pound. We already talked about the dollar index itself, and a little bit in the euro as well. So this is important because we're all talking about Brexit, and Brexit, the referendum is in just a couple of weeks. The market is, and even central bankers are very worried about the risk that the turmoil that it can pose for the global market. But, chances are, the Brits will probably end up voting to remain in the European Union. And if they do, that could lead to significant short squeeze, which would be consistent with the seasonal factors that we see in pound dollar in the month of June. So, all of this is, I think, good to keep in mind just because of how strong seasonality impacted currencies in the month of May, and how we do have a pretty consistent story for the dollar index as well in the month of June. But of course, there's a lot going on. Fundamentals can overshadow past price action. But I think some of our listeners will find it interesting.
Yeah, very interesting. We'll definitely keep an eye on those seasonal trends, as you pointed out correctly, with the dollar strength in May. Let's see, David DUTKEWYCH, kind of the mirror image of the strong dollar in May was the fall we saw in precious metals. Gold down about 6.5%, and silver tumbled about 11% last month. What do you make of that in the markets overall in terms of your expectations going forward?
Hi, Mike. Hey, everyone. Yeah, you're right, Mike. Gold, copper, silver basically were the worst performing assets for the month of May. And then we saw kind of on the opposite end of that, oil was one of the better performing assets for the month as well. But when you look at the precious metals, we'll start with gold. It reached up and, just broke above 1,300. It got to 1,306. And then earlier, I think it was yesterday morning in early trading, it just cracked the 1,200 mark, getting down to 1,199. So we have that $100 range that we've seen gold trading in now. We're kind of at the lower end of that. A lot of that had to do with that move in the dollar that we saw. But really what we're seeing now is, there's a pretty good fight. So I do think we could be in a little bit of a trading range here until we do see the next move in the dollar. Gold itself's been a little oversold. We did see a bunch of buying come in as we did get to that 1,200 support level. We might be able to bounce a little bit higher, but I wouldn't necessarily expect a huge bounce. Maybe we bounce up to 1,240, possibly the 1,250 range. I do expect to see us test that 1,200 range again. And if we can crack that, then we could see a little bit bigger move to the downside, where we could see, gold fall as far as maybe 1180, maybe 1160, possibly getting down to 1140. But I think that's contingent on if we do see the dollar strengthen here. And that's probably going to be contingent on the economic data that comes out and the expectations from the Fed. As I mentioned, oil was one of the better performing asset classes, finally got above 50 again. And it hasn't been able to hold that. It's pulled back down into that $48 range where there is a bunch of support. So we'll see where it goes from here. There's more support on the downside to around 46. If it holds there, we could try to press and actually hold above 50, get to $52, and maybe we'll really start to see some more momentum coming in. Natural gas, on the other hand, really has firmed up a bit here. It had a big move yesterday. It's up again today. It's kind of crossing over its near-term resistance around that $2.30 mark. If we can hold here, we should be able to press to maybe 245 to 250 level. So that's looking pretty strong right now. The grains have pulled back a bit, but again, they haven't broken down yet. So we'll see if they can hold, getting into some of their support levels here. On corn, it's about 400 to the 390 level. If we get that pullback and it holds, we could see that press higher again as well. As you mentioned, with the markets, they've been in a range. It wasn't able to crack the downside support around that 2039 level down to 2025 on the S&P. And again, we haven't been able to quite break above and confirm a break above that 2100 level. So right now we just need to see us kind of break out of this range to really where we're going to get our next move. And again, I do think the economic data is going to be the most important thing here.
Okay, thanks, Dave. We'll definitely keep an eye on some of those key levels that you mentioned in the markets. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all. And be sure to tune in again next week. Until then, I'm Mike Burnick from Money and Markets. Good investing.